Hello, good afternoon. Welcome to the latest in our series of webinars from the Saïd Business School at University of Oxford. So this is in conjunction with the Oxford Real Estate Programme and the Future of Real Estate Initiative. So the Oxford Real Estate Programme is a one-week executive programme for people working in real estate as a corporate, as an investor, or as a service provider. And the Future Real Estate Initiative is a research initiative chaired by Professor Andrew Baum in conjunction with a number of industry partners to build out real estate as an area of expertise in the business school. We are a couple of minutes late starting, so apologies for that. We'll kick off right away. Just a couple of notes of housekeeping before we start. So this session will really run as a Q&A. So my name is Steve Brewster. I'm an Associate Director here at the Saïd Business School, and I will ask a series of questions to Professor Andrew Baum and Elliott Sparsis, who's our guest for today. And we have a series of questions, but it would also be very helpful to hear questions from the audience as well. So if you have any questions, then please key those into the questions panel, which you should see in front of you, and we will address those at about 22:30 once we get to the end of our list of questions here. So with us today, we have Professor Andrew Baum. Andrew is a professor of real estate here at the Saïd Business School. He leads the Future of Real Estate Initiative. Andrew has a 30-year career in researching developments in real estate and real estate investments, and in parallel has had a industry career starting and selling off various companies in that time, and is still actively involved in the board of various businesses. So there's no better person to hear from the current state of the real estate and real estate investment market. And Andrew has invited Elliott Sparsis today, who is the VP of Real Estate at Convene. We'll hear a little bit more about Convene as we start, but needless to say, it's a shared office provider internationally and opening in London. Elliott has been there for about a year as VP of Real Estate. Before that was 6 years at Blackstone, again working in their real estate practice. So Andrew, over to you, please.
Okay, so the topic today is under the general banner of the Future of Real Estate, which is our research initiative that's been going on for a couple of years now. And this particular topic that we're focused on is to do with space as a service. And it's triggered by the publicity that has surrounded WeWork in the last 3 to 6 months, and in particular its failed IPO. There's been a lot of chatter in the property market about WeWork as an innovator, a disruptor, but amongst a lot of traditional real estate people, it's been seen as a dangerous example of a tenant that you wouldn't wish to have in your building. And I'd like to sort of explore both sides of this and work out how we view WeWork as an innovation and as a failed IPO. And we're going to focus and start off with talking about what WeWork is and work out what's happened to it. And I think we'll kick off with that question, if that's okay with you, Steve. So
yeah, sure.
So I'll ask the question the first time, and then I'll hand over to you to ask us the rest of the questions. But Elliott, if I could sort of invite you in at this point, can we talk about what WeWork is and what's happened to it recently?
Absolutely, yeah. An interesting question, and I think the answer is very different today than what the answer would have been 3 weeks ago before the IPO failed. I think what we've all got to remember is that WeWork, from a four-wall individual building and product perspective, is a fantastic amenity to have in a building, and their product that they deliver into the market, there's massive demand for. So they're the first operator that has managed to grow at an exponential rate, and that's really through demand from consumers that want to buy their real estate off the shelf and don't want to commit to a long fixed lease that has no flexibility. So first and foremost, their product is fantastic and there's a lot of demand for it. Convene sits at a very different end of the market, but if you are value focused and you are a new startup business, what better way to reposition your office than in a WeWork in a central location where you're surrounded by like-minded businesses. So I think fundamentally, let's not forget that the product they deliver into a four-wall building is a fantastic product, and there's a lot of demand for it. I think from a macro perspective, we've all read lots of reports around Adam Newman and how he's abused the SoftBank debt that's been provided for their expansion, and that's completely separate to the physical product. I mean, the business has been run in a very poor manner from a financial perspective. It's grown exponentially, and the costs have run to tens of billions of losses since the SoftBank investment just over 4 years ago. So I think you've got to separate. The physical product is fantastic. How financially the company has been structured and operated and run under Adam Newman has not been successful. So is there longevity in WeWork? Absolutely. Is there demand for their space? Absolutely, at the price. So I hope that gives.
So what happens to WeWork at the moment? Has WeWork gone bust? Is it still running? What do we think are its medium-term prospects?
I mean, WeWork is still very much running. You walk into any of their sites and they're still busy. There's still demand for their product. Yes, the demand has come off a little bit. Yes, there's a little bit of uncertainty around businesses that are in their space. From what we understand, they are currently under offer on 4 additional new sites in central London that they're now not going to execute. So the business plan very much is, let's restructure the real estate that we have on the books. Let's ensure that the business is restructured and capitalized in the right way. SoftBank has committed to a further tranche of lending and debt to ensure that it physically doesn't run out of cash on a day-to-day basis. So yes, the product's still there. Yes, the business is still running. That's not going to change. Are we going to see continued growth? No, at the rate that we've seen it. May growth come in the future when the business has been restructured? Absolutely, potentially. They're currently the biggest landlord in central London. They're just under 4 million square feet that they have under operation. It's about 40,000 desks that they have here in the capital. So they've got a huge catchment of real estate that they control. So yes, the business is still trading, business as normal from a four-wall perspective. We've all read the reports of the new individuals that are now running that business and working very hard to try and cut costs and mitigate the losses that they're currently reporting.
Yeah, so real case study of kind of corporate governance and what can work and what can go wrong there. So if we kind of separate that governance issue from the product and the market issue, if you like. So when I was working in London back in the 90s, WeWork didn't exist at that time. There was places like Regus who, you could rent a small office or flexible working space there for meetings and so on. So it'd be helpful if Andrew, if you could give us a quick recap on how we got here. So what is the history of flexible office type offices?
Regus is a great place to start. I think it may or may not have been the first ever provider of flexible offices, but it would certainly be the brand that captured that concept in 1989. I think it started, and it was in the early 1990s when it really got going, which was ultimately unfortunate for it in its early stages, but it's a survivor. It's a real survivor. It's still there. International Workspace Group is the head company for this, and they've got a series of brands underneath that IWG banner, including Regus and Spaces, which is bigger than WeWork, by the way, and other businesses. So you've got to go back. I think London provides a particularly interesting background to this, because the typical lease a London office in 1989 would have been 25 years with 5-yearly reviews, upward only. And the idea that a tenant of a high quality office building was expected to sign a lease for 25 years is pretty horrific. If you're a smaller company, how do you face up to that? And even in less high quality office space, you might be expected to sign a minimum 5-year, possibly 10-year lease. So Regus came into the market and offered what it called flexible offices. What it really meant was flexible leases, where you could sign a much shorter lease length for a small amount of space. And it meant that Regus immediately chose an operating model which a lot of people criticized as being incredibly risky. And that operating model involved them taking long-term lease liabilities, because they were forced to sign 25-year leases and actually chose to do so because it gave them security of knowing that they had a building for 25 years, but then subcontracting or subleasing smaller spaces within those buildings on shorter leases of anywhere from 3 months upwards. And that model was criticized when it got Regus into trouble in the early 90s. And it got Regus into trouble because the dot-com crash meant that a lot of small businesses went out of business, and it meant that the businesses that had taken flexible office space, often as overspill, cut that space as the first decision they made, because they were committed to 25-year leases everywhere else. So the only thing they could get out of would be these shorter leases with Regus, which meant Regus lost a lot of occupants, both big businesses using overspill space and smaller startups. And when they lost those businesses, the real estate industry piled in and said, well, there's something fundamentally wrong with your operating model. You shouldn't be signing long leases, making long commitments, and having short-term assets. But that's palpable nonsense, because that's the way a hotel works. You know, if you sign a 25-year lease on a hotel and people stay for 1 or 2 days, then you've got exactly that issue. So there's nothing fundamentally wrong with having long liabilities and short assets. Elliott, do you want to come in on that point?
Yeah, absolutely. I mean, Regus have had to evolve over the life cycle of their business, and there was an interesting interview a couple of days ago in the Times by their CEO, really trying to compare their value and their multiplier on revenue in comparison to WeWork. And for the last 4 or 5 years, they've really sort of tried to unpick why WeWork were at an 8 times multiplier and they were only at a 2 times multiplier. And it's clearly now rebalanced and the market is back to a 2 times. So, but I mean, on the physical product, there's definitely a demand for what Regus do. I think it's probably fair to say it's larger corporates that are putting temporary back of house functions into a WeWork demise. It's a necessity rather than a emotional or business plan decision to put employees into a Regus. For a startup in a WeWork, it's driven off of trying to attract talent that's from a similar demographic that's going to aid their business. So there are clear differences, and listen, Regus have proven the test of time over the last 15 or so years, but they definitely left a pretty bad taste on the market, as Andrew has just said, when they walked away from the number of SPV liabilities that they had on their balance sheet when our wider economy was in a difficult position.
I think that's introduced an interesting issue, actually, Steve, which is again another negative connotation that went around the market with WeWork, was this idea about if you are a British Land or a Crown Estate or a Landsec and you own a lot of office buildings in London, and your fundamental business model is to lease that space out for as long as possible to as high quality a covenant as you possibly can, in order that you are collecting a very secure rent for a long time. You've created a sort of near bond type investment. What you want then is JP Morgan signing a lease for 15 years. If WeWork becomes the biggest landlord in London and also the biggest tenant in London, because it sits in the middle, then what you want is a company that's extremely sound financially, so that you can rely on their covenant. And one of the negative words that went around the market was to do with the way in which WeWork might put a particular office building into an SPV, so that each occupation would be ring fenced from the head company. And that's the way that Regus operated in the early 90s as well. So it suited a lot of incumbents in the office market who were negative about WeWork, pointing out this issue that you were only going to get the covenant of one particular operation, and it wasn't going to be covered by the bigger operation. And that came from Regus. So these two negative ideas in the market, in the capital markets, that number one, you've got long liabilities and short assets. And number two, that you've got these SPVs guaranteeing the rent rather than the head company. That sort of produced a negative flavour in the property market, particularly amongst those that had a vested interest, A, in low risk offices and long leases, or B, in just sort of not being particularly interested in seeing their business chewed up by an innovator or disruptor.
Okay, thank you. So if I'm an office landlord in London today, what are my options? I guess, is WeWork still an option? What would be my other options, and how would I prioritise those?
Let me kick this one off and hand over to Elliott. I mean, you know, if I look at it from a landlord's point of view, I suppose I've got 3 or 4 options, and I'm sure Elliott's going to tell us about the third or fourth. But so the first one is that I seek a single tenant who's going to sign as long a lease as possible, and I get somebody signing a lease for 15 years, possibly with a 10-year break, and that business is of absolutely sound financial strength. It's a bank, or it's a government or near government business. It might be Facebook, it might be Amazon these days, but something where the value of a 15-year contract with that person paying the rent is very, very valuable in a world of low interest rates. So we're maximizing the value of that income. So that's option number one. Option number two is that we multi-let the building, so that we have a series of tenants in the building who are signing probably slightly shorter leases, 5 to 10 year leases, and we accept the fact that we're going to have to manage that building reasonably actively. So people are coming in, going out. We probably get a slightly higher return out of that because we can push the rents up a bit more, but we're going to have operating expenses, and we start to involve ourselves in the building as an asset manager a little more, as an operator. Third option, presumably, is that we become a co-working operator, so that we do adopt a WeWork or Regus type model, and we look for very small businesses and we give them total flexibility over lease lengths, so that we now become like a hotel, hospitality business. We are absolutely on the ground operating, and we are managing the facilities on a very active basis day to day. And that's a riskier model. You know, we've got less certainty of income, but again, it should be more profitable. Right. And then Elliott, I'm sure you've got another idea.
I guess it's just sort of going back a stage. When you ask what does a landlord need to decide, you've got to first ask your question: who the landlord is, what's their capital structure, what's the business plan for the asset? Are they a long-term holder, or are they PE money that's going to trade that building as soon as it's fully let? So that's the first question. The second question is, if a landlord has made the decision that they want a flexible operator within the building that they own, 22 Bishopsgate is a great example. It's a multi-tenanted building. AXA, who are a French pension fund, own the building. It's a long-term play for them. They're not going to trade the building. They want to maximize the rental income over a long period of time and create sticky income within 22 Bishopsgate. So the 3 questions that the landlord then asks themselves if they want flex is, the 3 options are: do they buy an operator, do they build their own operator, or do they partner? So the buy strategy is something like what Blackstone have done. They've bought TOG, they'll roll them into the buildings, they'll have control over that full portfolio. The build option is what British Land and Land Securities have done. So Land Securities have created MIO, they're building their own operations. Convene is in that third bucket if a landlord wants to partner with a flex operator. And we're definitely that partnership option. And I think what we've all got to remember is that real estate businesses are not operation businesses. To run an operation business is very, very different. The Crown Estate is a great example. They're a huge property business. They own most of Regent Street. There's probably half a dozen individuals that manage that portfolio. They have, in the last 12 months, decided to build their own flex platform in One Headham Street in the West End. Off the back of that, becoming an operator, they've had to double their headcount of individuals to run a 15,000 square foot flex operation in comparison to owning the whole of Regent Street. So that gives you some sort of idea. If you want to scale up a flex operation, you need a huge head count, and it's a very different business to what a real estate business is. So jumping back to 22 Bishopsgate, AXA made the decision that they wanted to partner with a best-in-class operator. And what Convene essentially does is we are a hospitality and operations business, and our business plan is predicated off the back of, let's create a hotel service that sits within an office four-wall opportunity. So everything that you would see, feel and touch when you're in a hotel environment, you can now also get that within your office. So Convene at 22 Bishopsgate will run 100,000 square feet of true amenity space for the rest of the building. Half of our space is premium meetings and event space, and half of our space is premium workplace. And it's really a drive for shared infrastructure. If you think about a multi-tenanted building that has 5 tenants, it makes absolutely no sense for those 5 tenants to all have a large kitchen that is very expensive to build and very expensive to operate. It makes no sense for those 5 tenants to all have a large auditorium that's in their space. Again, that's very expensive to build and is underutilized. It makes so much more sense for tenants upstairs to take between 5 and 10% less net area in their core space take and outsource all of the large infrastructure items that are underutilized and very expensive to operate. So at 22 Bishopsgate, we'll have a large 3,000 square foot commercial kitchen that we can provide vertical catering to all of the tenants upstairs in the building. And we give them technology that they can order that F&B to be sent up to their floor. We also have 5 large auditoriums ranging from 100 people to 400 people that allows businesses within the footprint of this building to buy a certain number of days to use our auditorium, which then allows them to outsource that space. So operationally, it takes all of that headache out of their balance sheet from a top line perspective. The same with running the F&B, the same with running the kitchen. So from a bottom line perspective, it works a lot harder for them and they can concentrate on their core business. So I guess it's a shared infrastructure. Convene's been running for 10 years. We employ 800 people in the US now. We've got 35 sites. Every single building we're in is a partnership with the landlord because we want to work together with the landlord to create space upstairs that's more attractive for corporates to take. So a great example is 22 Bishopsgate and 100 Bishopsgate, both on Bishopsgate, both brand new office buildings that have come out of the ground. A number of tenants in 22 chose this building because they have the ability of utilizing space that Convene will run in the bottom of the building. And it allows them to outsource all of that unnecessary infrastructure that's very expensive for them to build and very inefficient for them to use. So if you start thinking about it like that, it makes a lot of sense.
Yeah, no, that does make a lot of sense from an ownership perspective. Again, from a kind of general user market perspective, I guess thinking back again to maybe the 90s, what's changed in office demand since Regis introduced this in the 90s? What's changed over the last 20 years or so?
I suppose the first thing that we ought to point to, and I'm sure Elliott will have a view on this, is the increased number of self-employed people who, by definition, are extremely small businesses who want to be and need to be flexible because they simply don't have any credential which would make them credible as the signer of a long-term lease for significant space, and they certainly wouldn't want to do that. So I think what's changed is the gig economy, the number of self-employed people, the sort of the ability of people to commute long distance and therefore use space only on a Tuesday, Wednesday, Thursday, not necessarily all week. Flexible working is a genuine change of attitude and habit, and the long lease of a building simply wasn't a product, a supply product that matched the demand characteristics of this increasing group of people. Over to you, Elliott.
Yeah, I mean, that's very true. And I think the increase in startup businesses has definitely aided the WeWork expansion. If I'm honest, that type of business is not our core client. We're really targeted at 20 to 100 people businesses that really want to drive on staff retention, staff attraction. They want to be proud of the real estate they're in. They might have a lot of clients that visit them, and they want to be an environment where they're confident and proud to invite clients into. But to sort of go back a stage, what's changed the environment for flex in our eyes is technology. And we've seen that across every single sector. You look at Deliveroo, you look at Uber, you look at Airbnb. Those businesses were not possible without the need of technology. And it's exactly the same to be said for our business. We would not be able to run vertical catering in a multi-tenanted building like 22 Bishopsgate without technology. We would not be able to encourage tenants to outsource their auditorium in a seamless way that they can book that meeting room through technology we give them without having the capabilities that we have in today's world. So technology is a big difference for us, and that's driving flexibility, it's driving efficiencies, and it's ultimately forcing office buildings to work a lot harder.
Elliott, just Andrew here again. I'm just questioning. I'm sitting with Andy Saul at the moment, and he and I are working on a project on space as a service and connecting that to productivity. Do we have any evidence that people who are occupying buildings that have this flex space are happier, more productive? Whether the businesses that occupy this space are doing better as a result of it than using a traditional model?
I mean, that's a great question, and I think the way that you compare that is what are regular license periods for businesses using our space. We're averaging at about 2 years at the moment per business, which is a lengthy process for occupiers to stay within a flex operator. WeWork average between 9 and 12 months. That tells you that that business is moving on for whatever reason. So the fact that businesses are staying within a Convene tells you that it's working for their business. How you link that back to specific areas is what I've really said before. If you're a business that has a drive on staff retention, there's a large business that's in the market at the moment for 800 desks for a 3-year period. Now, this is a big UK conglomerate that have got 7 offices outside of London, and for the last 10 years they've struggled to attract and retain the right quality of staff. They've now made the decision to move out of those 7 offices and rent 1 flexible office for 3 years in central London, primarily based on the reason that they want to attract and retain better staff. So I think that's a great indicator that real estate is a catalyst for you attracting, retaining, and ultimately moving your business forward.
Okay, perhaps sorry, this is Andrew. This is Andrew Baum's colleague. What exactly do your clients want? Do you have any evidence as to, I like to call it the arms race of amenities? Is there a particular 1 or 2 products that all your clients are demanding, or is there just a bare minimum that you need to provide in order to keep everyone happy?
Yeah, I mean, there's a number of sort of wants. Flexibility is obviously the main drive for why businesses are buying flex. They don't want to commit to a 5-year lease if they've got 100 employees and they need, say, 10,000 square feet. They don't know what their businesses is doing in 12 months, let alone 5 years. In terms of physical amenities that we offer within a building, we're really trying to create a one-stop shop that keeps individuals within an office building for a longer period of time, and on the back of that, staff are more productive. So we've just opened a new site in New York at 530 Fifth Avenue. We partnered with RXR, who are a huge New York landlord, and we essentially have 5 different products that sit within that space. We have our high-end meetings and events. We have our workplace. We also have wellness and sleep pods. We have Peloton rooms. We have F&B and private members club. So the idea is that it is a full service offer. An employee comes into the office, after you.
Sorry, how are you defining staff are more productive under that that scope that you just mentioned? Is that in terms of just hours spent at their desk, or are you actually seeing a lift in the number of emails sent, or are you just purely measuring the output, the financial performance of the companies within your space?
Yeah, I mean, we're not monitoring individuals within businesses. We're really monitoring that business and how long they stay in our space, and are they growing or are they shrinking as a result of being within our space. So 65% of businesses are growing within a Convene off the back of being able to attract and retain the right staff. So that tells us the physical real estate is having a benefit to that business to be able to attract and retain the right staff. What those individual staff members are doing is not our business and not what we get into. We're looking at the sort of macro need of what that business wants.
Yeah, awesome, thank you.
Yeah, thank you. Going back to WeWork then, if we think about, what particular benefits has the introduction and growth of WeWork over the last 5 years or so really brought to the sector? What benefits has it brought for, I guess, for building owners, but also for occupiers and tenants?
Can you start with that one, Elliott?
Yeah, absolutely. Two things. It's shown businesses that they can buy real estate off the shelf, right? They don't need to sign a 5-year lease.
Yeah.
They don't need to commit X millions of pounds for their fit out. They don't need to get involved with what a way leave agreement is. They don't need to find an architect. They don't need to find contractors. They don't need to have double overheads because their construction of building out a new office has been delayed by 3 months. They now need to carry a double overhead on the office they're moving out of. So it's shown businesses that they can buy real estate off the shelf, which fundamentally is very important. What it's also done is it's shown businesses that they can have ultimate flexibility within growing and shrinking their headcount. They don't need to sign 10,000 square feet for 5 years and hope that that business is going to grow into it over a 3 or 4 year period. They can sign flex on a 12-month license and dump half of their space if they lose a contract in 6 months. So it's buying and it's flexibility.
Bang on, Elliott. Speaking as a former WeWork tenant, I can absolutely reaffirm that. And one of the reasons why we asked you on this call, Elliott, is that you remember that we invited you to speak to the Oxford Real Estate Programme earlier this year in 2019, and you were the first person I heard stand up and say that we really need WeWork to succeed here, because it's taken the property industry, and there are so many people in the industry sort of wanting them to fail because it takes us backwards to a model where those guys are going to be dominant. And that was impressive. I'd say as a former WeWork tenant, those 2 points are absolutely it. It's the speed with which we can move in and operate, and the speed at which we can move out, and the flexibility of it.
Completely.
And coupled with that, then one of the reasons why WeWork has got its detractors is because it over advertised a lot of other things that they either pretended or really believed were important, like community building, and everybody will talk about the free beer and so on. And I found that was just overhype. We weren't particularly interested in building communities. It's great to bump into people in the coffee room, but it's that's overstated. It really is the plug and play aspect of it that's so valuable.
Completely, yeah. I mean, WeWork, you've got to give them full credit. They've managed to make their product a consumer-facing, desirable name. Okay, not so much now off the back of what's happened, but businesses were very proud of saying, I'm in a WeWork, right? Businesses never before said, I'm very proud of being in a land securities building or a British land building. So it's actually attributing some physical value to knowing the name of the operator of the space that you're in. But another massive point for us is, and why we're really supportive of the need for WeWork to continue, is that it's actually an incubator space for us. So businesses start in WeWork, they might be 10, 5 people. They really enjoy buying their real estate, off the shelf in the way that they are. And if they're a growing business, they graduate out of a WeWork and they want something that actually depicts the growth of their business, and they're prepared to pay for it. So WeWork is £600-700 per desk per month. We're £1,200 per desk per month. And if you've already bought your business, your real estate off the shelf and realize it works, jumping into our space is a natural progression once your business is moving in the right direction. So we actually see a lot of graduates coming out of WeWork, moving into a Convene because their business is moving in the right direction.
Okay, thank you. So we're starting to get a couple of questions come in from the audience as well. And just as a reminder for people out there, if you do have questions, please put them into the questions panel and we'll ask them either at the end or as they come up. One of the ones which has just come in from Carrie is on a related point. I'll just read it out loud. So WeWork has stated in the latest investor presentation that going forward, they'll be focusing solely on their enterprise business. If the fundamental success of the WeWork model to date has been driven by small to medium-sized businesses and startups, what does this shift for the future? What does this shift mean for the future of WeWork and their amenity value proposition and for the buildings in which they reside? So as WeWork have said they're going to focus more on the enterprise business, how do we think this will, what's the future of their business to date?
We have a stab at that. It's not something I know the answer to, and Elliott might, but my guess is that their future growth will be focused on enterprise business. And what their enterprise business is, I think, is partnering a little bit more like Convene with bigger landlords and operating their space for a single landlord as if it were co-working space. So that they might partner with JP Morgan to fit out a JP Morgan office building like WeWork space, and to sort of generate that feeling of collaboration and flexibility within a sort of traditional business. The reason that they might do that going forward is that they've got a much better chance of matching their revenue with their cost by doing that. So they can charge a rent or a fee from JP Morgan which matches the cost of producing that operation, so that they're not going to continue down this ever increasing loss-making business where they're trying to invest in the brand to grow. So I suspect that's the answer, that they're trying to reduce their business risk by matching their income with their costs. They can do that more easily by partnership with an enterprise business than by taking the risk of starting a new open space business.
It's a great question, and I think WeWork are trying to reposition their brand in the market. They don't want to be seen as only targeting startups now. They want to be seen that they are a grown-up operator and they can attract these larger tenants. So I think that's the first point. The second point is the enterprise business is tough, really tough. And it takes a long time. It's a lot of consultancy. It's a 2 or 3 year negotiation with some of these bigger businesses sometimes. So it sounds fantastic and romantic of putting these big businesses in your space, but it's tough. It's hard. Everyone's trying to do it, and it takes a long time. So yes, that's where the world is moving, but it's not an easy part of the business.
Okay, thank you. Related, I guess then. So what do we think is the outlook for office operations? Will leases change, or can we all breathe a sigh of relief and go back to the old model?
I think, yeah.
One of the things that Andy and I are working on here is we're fascinated by the connection between productivity, happiness, success, however you define it, and the operating model. How do we connect a successful business and a happy operation with the way in which that building is managed and run? So if you're running one of our partners, for example, came to us and said, I'm not completely sure I know who my customers are. I don't really know what they want. I don't really know what data to collect from them, but I'm aware that everybody's telling me that I really ought to know my customer. I really ought to be collecting data, and I want to be offering things back to them like WeWork would. Mm-hmm. And it sort of dawned on us at that point that the traditional office landlord has several degrees of separation between them and their customer. So you might be a pension fund owning an office building. You might be operating that building in conjunction with an asset manager who's got a financial interest in the building. That asset manager might be appointing a property manager to collect the rent. The property manager is dealing with a facilities manager representing the tenant, and the customer, the guy sitting at the desk or woman sitting at the desk, has got no connection whatsoever with that pension fund that owns the building. Whereas if you take a pure play hospitality model where the building owner might be the building operator and they have a direct relationship with their customers, their B2C business or B2B business, then they know what day to collect. They know what when you stay in the hotel, they know how many nights you stay, you know what you eat from the mini bar, you know, they know what sort of room you like and they know what sort of dinners you eat. And that's quite useful in offering things back. So will we go back to the traditional long lease model? I'd be very, very surprised if that were true. And I suspect that WeWork has helped to break this model and to introduce this idea that hospitality is the way of thinking about this.
Elliott, does that, would you agree with that theory?
Absolutely, absolutely. Yeah, I mean, we're only at the start of what flexible looks like. London is 250 million square feet of offices. We're currently at an 8% market share of flexible providers within our space. WeWork are predicting it's going to get to 30% by 2030. That's another 25 million square feet that's going to come through as flexible. But I mean, we're now seeing bigger businesses buy flex, right? HSBC have taken 800 desks 6 months ago from WeWork on the South Bank. I mean, that's a mega deal. And that tells you that businesses are comfortable buying flex on short-term businesses and it's working for them. So I think as long as the big businesses keep on buying flex, that demand is there, then this sector is only going to grow.
Okay, another question which has come in from the floor, as it were, from Joe 10 minutes ago or so. So we talked about what are the options if if you're a landlord. What are the options if WeWork is a current tenant in your business?
No, so the question I think is if you're a landlord of a building in which WeWork is your tenant, do you need to panic? And I think the answer is no. WeWork received I know Elliott might know better than me, but it received another cash injection from SoftBank of 8 billion recently. So it's burning money at the rate of $1 billion a year. It's got 8 billion of new debt or equity, and I'm not sure which. So its existing operations can be financed through, and no doubt they're going to be concentrating extremely hard on cost cutting and making sure that all of the offices that they're committed to will become cost covering. The question is, if there are loss-making operations that WeWork are running that they can't turn around, have they signed a lease which is guaranteed by the holding company, the We company, or is it an SPV that signed the lease, the tenants that the landlords accepted, in which case WeWork could switch off at any point to save costs? So that's the question. It's down to whether the signee to the lease is the head company or an SPV.
Elliott, anything to add to that one?
Yeah, I think there's probably a little bit of lost faith in having WeWork as a tenant. Does that materially impact the capital value? Maybe by 100 bips. Would you put WeWork in a whole building today if you're going to try and trade that building tomorrow? Probably not. But is WeWork going to continue to pay their rent on the real estate assets that they're in? Yes. They're trading very well from a forward perspective. Their margins are great. They're 25, 26% margins from a forward perspective. So from an individual asset to asset perspective, the business is doing well. Structurally and corporately, it's not. But that's a different situation. That's not going to change.
The losses, Elliott, are due to over-expansion. In other words, they're always fitting out a building which is not a revenue generating and incurring losses through growth. It's not the existing up and running businesses that are making a loss.
No. The existing businesses that are trading today are running at about a 25.5% margin. So they're in a good position, right? There's demand for the product that they're selling. So corporately, it's a mess, and yes, SoftBank are backfilling them, and they will continue to backfill them because they're so long on their investment. What happens in a doomsday scenario if they do collapse an SPV? Then the reality is there's enough demand for other flexible operators in the market to acquire that space. So landlords are not
And you
going to be
take over the fit out at no cost, Elliott, right?
But exactly. So
Yeah.
So do you think that the WeWork news has damaged the sector, or is the momentum just going to keep on growing?
Both.
Yeah. Listen, it's taken. We all talked about ourselves as probably tech businesses before the WeWork situation. We're now back to being real estate businesses. We're not valuing any of our businesses on a 6 or 7 time revenue multiplier anymore. We're back to a 2-3 times revenue multiplier. So, and that's where it always should have been, right? That's the reality of the real value of what we're doing. We're never at a 7 or 8 times multiplier. So I think it's been healthy actually for our industry. It's restabilized the value of all of our flex operations, and actually for us, longevity is in partnership with the building owner rather than acquiring space for the sake of it. We want true partnerships.
Yeah. So we're just blown away the hubris, in other words.
Yeah. Another question which has just literally come in on WeWork. Can WeWork be easily imitated or bypassed from a developer perspective? How far ahead are they with their services? And is there anything that particularly that particularly holds them apart and differentiates them from other suppliers, maybe such as Convene or others in the market?
That's
reputationally, they've definitely been damaged. We're having more conversations with landlords that were previously potentially talking to WeWork. So from a reputational perspective, it's definitely going to take them a little bit of time to get over the uncertainty in the business that they're going through at the moment. So that's definitely going to take them a little bit of time to restabilize and readjust that external perception. Longevity, and can other operators overtake WeWork? Absolutely. Is it going to happen overnight? No. In the medium to long term, will it happen? Absolutely. Yeah, I mean, you look at the tech world, Amazon were behind a number of different online marketplaces 10 years ago. They're now by far the market leader. So those shifts can change.
Okay, great, thank you. Just a couple more questions. This one's maybe for Andrew, but so yeah, if a commercial property has WeWork as a long-term tenant, what happens to the cap rate when the property is valued for capital value purposes? Is there a cap rate compression or a cap rate expansion?
I don't think there's any doubt about the fact that if you had WeWork as a tenant compared to JP Morgan, you'd end up with a higher cap rate and a lower capital value than if you had a traditional tenant. So even pre the bad news, WeWork would not have been as highly valued a tenant as a bond-like bank as a tenant, but the difference wouldn't have been huge. Such was the feeling that you've got a vibrant operator that's growing. When I think post the news that the valuers, we don't know the answer to this yet because it's going to happen in the December valuations this year in London and probably New York, when valuers are going to be asked the question about what do you do now to the valuation of a building with WeWork as a tenant. I suspect you're going to move it out. Elliott suggested 100 bips as the sort of the value differentiation. I suspect there will be some significant value differentiation of between 0.5% and 1% in the value of that building.
Okay, fantastic, thank you. We've just got a couple of minutes left. So Elliott, maybe a last question for you. Obviously, we've heard about your facilities opening at 22 Bishopsgate and so on, moved to London. Are there any other comments we should like to make about the London market in particular and what we might expect from Convene?
Yeah, absolutely. From a sort of high level perspective, our business plan, and we have funding in place to acquire about 500,000 square feet in central London over the next 3 years. We want to be in the 4 main sub-markets, so Canary Wharf, City, Midtown and West End. Once we open in those markets, we'll use London as a showroom to get into Europe. We're having a lot of conversations on the 4 big German cities. Paris is featuring a lot. Amsterdam is on the radar. So, but for us, we're growing for the right reasons. We're taking space in markets where we have demand from our global clients. So we work with the majority of the FTSE Fortune 500 businesses in the world. We've really listened to them in the US, and they've consistently over the last 4 or 5 years been saying to us that they want our offer in central London. So we're not acquiring space for the sake of it. Everything we do is a partnership. We want to have some downside protection in the early years on our rental liability, but then once we stabilize and we underwrite at 3 years, we then share upside with the building owner. So we've got to be integral in the real estate. We've got to be joined up with whoever owns that piece of real estate. And ultimately, it's about driving more value for the tenants upstairs and creating office space that works harder for A, the landlord, B, the tenant, and C, us at the same time. And that's bringing the hotel philosophy into the office environment, which is exciting and just hasn't been done across the globe as yet.
Excellent, thank you. I think it just works as another example in terms of seeing how the real estate industry continues to evolve. And on that point, Andrew, in the last minute or two, I know we've got various research projects going on, but is there, what research are we doing at Oxford currently that is in this space?
To go to one of our earlier slides. No, not there, sorry. Yeah, so we are interested in working out the connection between the way in which a building is operated and the productivity of that building.
Quite simply, the World Green Building Council released a statistic that the average organisation's operating costs are 90% their staff salaries, only 9% their space in their real estate, and 1% energy. So a lot of the discussions we've had today about space utilization, how can we increase the vacancy of the spare capacity within buildings through co-working facilities. However, if you could prove that certain building amenities, a certain way of operating a building would increase the productivity of the 90%, that offers a far more financial reward to organisations in a piece of real estate than does the space utilisation, which is the 9% of their costs, or any energy savings, which is 1%. So a lot of the questions in the market now are less around how can we get full desk utilisation and how can we create a productive space within which we can put prospective tenants. And so we're really looking into, hence my questions about what amenities, how we measure production to Elliott. We're really interested in trying to find out how to increase the productivity of the space, not just the desk utilisation of an area.
I mean, that's a great, if I can jump in just to give a little bit of background on that, that is an absolute key metric as to how we use space. Convene acquired a business 2 years ago in New York called Beco, which is essentially beacon technology that monitors the horizontal and vertical movement of individuals within office space. What we learned very quickly is that if you look at a room that potentially has 6 seats in a meeting room, we can monitor that space and look at the consistency of how many people are in that room and what the capacities are. And what we learned is that a lot of rooms are not being utilized to the size that they're built at. So a 6-person room normally has an extra chair dragged in, and we can see there's always 7 people in that room, or there might always be 5 people in that room. So we can then alter the size of that room and the seating arrangement to be able to fulfill the demand of the occupier that's in that space. So it's about ongoing monitoring of space and how users within that office building are utilizing specific rooms. So that's a red hot topic.
Find a metric for how the users of that room can do the maximal efficiency of work within that room. That may be having 2 people in the room, maybe having 7. Not a space utilization statistic, not an HR statistic lowering sick days. The actual productivity of an individual in that space.
I suspect we might still be talking about how we do that in about 15 years' time.
I believe so.
Yeah.
But it's a great one going around asking people how to measure productivity. So
yeah. Okay. Excellent. Thank you very much, guys. We're coming up on time. So thank you, Andrew Baum, Andrew Saul here from the Future of Real Estate Initiative at Oxford, and obviously Elliott Sparsis, VP of Real Estate at Convene, for your time today and all your input there. Basically, if people want to stay in touch and find out more, then we will be running another webinar in this series in the new year, and we'll be circulating dates on that. Other things to be aware of as well is that we will have a networking evening in London. I think it's 28th of January at the EY office, where we will bring out the second edition or the updated edition of our PropTech report with Andrew Baum and contributors to that from the Future of Real Estate Initiative. We'll also be inviting alumni working in real estate and from our Oxford Real Estate Programme, people interested in the Oxford Real Estate Programme to that evening. That's 28th of January. And then shortly afterwards in that, we will be having our Oxford Real Estate Society conference here at the Saïd Business School in the spring, I believe in March as well, but I will confirm the dates on that. Obviously as well, this webinar partly brought to you by the Oxford Real Estate Programme, which is a one-week executive development program for professionals working in the real estate space. You'll see on the screen in front of you some of the topics which that builds around. The next one of these we run once a year, and they do sell out in advance. The next one starts on the 23rd of March to the 27th of March. We have spaces left now, but once it comes through to January, February, they will be getting tight. So if you are interested in finding out more about that, then please do contact me. My details are on the end here. Steve Brewster at sbs.ox.ac.uk, and you'll see me whiz through some slides there. We're very happy to go through those with you in full detail if you're interested. Thank you very much, everybody online for your time today. Thank you, Professor Andrew Baum, Andrew Saul from the Future of Real Estate Initiative, and Elliott Sparsis for your time, and speak to you again soon. Thank you. Goodbye.
Pleasure. Thanks, everyone.